In this video I'm going to take a look at capital gains tax in Ireland. It's going to be an overview, it's going to be a look at the essentials. I would caution you at the outset to get tax advice if you are at risk of incurring a capital gain, or if you are involved with either of the capital taxes, especially capital gains tax and capital acquisitions tax, that is gift tax. But anyway, this video is going to look at capital gains tax. I have another video on my YouTube channel which you can check out, which deals with capital acquisitions tax, which is gift tax. So the capital acquisitions tax is a tax that arises for the person who receives a gift or receives a bequest or a devise in a will. Capital acquisitions tax is the tax that the donee, in other words, will be liable for, whereas capital gains tax is a tax that is going to arise for the donor or disponer or person who disposes of an asset, in other words the seller, not the receiver. The key thing is there must be a disposal of an asset. So if there's a disposal of an asset, capital gains tax arises when there is a chargeable gain on that disposal. It's calculated on the gain of the disposal of the asset. So if you buy a house for 150,000 in 2011, for example, and you sell it for 195 in 2020, then the tax is charged on the gain of 45 grand. Certain expenses which you're allowed to write off, the cost of acquisition, for example, the cost of disposal, legal fees, stamp duty, and so on. You may also have a tax exemption. So there is one very large tax exemption, and that is the principal private residence relief. In other words, if you sell your principal private residence and you are lucky enough to incur a capital gain, then you will be able to avail of the principal private residence relief, because there's no capital gains tax liability arising from the sale of a principal private residence. What's a disposal? There's 4 types of disposal. The sale of an asset, that's fairly obvious. The gift of an asset, that's not so obvious. So the person who is, out of the goodness of their heart, making a gift to somebody else is actually involved in the disposal of an asset from the point of view of capital gains tax. A part disposal, in other words, a person may have a farm of land and they may decide to give a son or a daughter or a nephew or a niece or somebody a site. So they're going to make a part disposal for the purposes of building a house. So that will give rise also to, or can give rise to, a capital gains tax. The setting up of a trust, that's less common, but if a trust is set up, then the property is going to be disposed or transferred from the owner, the registered owner of the property, to the trustees, and that transfer gives rise to a capital gains tax liability, or can give rise to it. The allowable deductions then in calculating the actual gain: 1, the cost of the asset together with the cost of acquisition. So the cost of acquisition would have included, for example, perhaps a structural survey before buying a property, stamp duty, legal fees. A second allowable deduction would be the amount of capital expenditure spent on the asset. So you might buy a house or a shop or something, and you may build an extension. That capital expenditure is allowable in calculating your gain. However, a revenue expenditure is not. So the ordinary expenses to do with running a business, for example, paying rates or electricity, or the cost of water or services, for example, to a property, are not allowable in calculating the gain. And then the costs of making the disposal are allowable as well. Again, you're going to have auctioneer's costs, you're going to have the solicitor's costs, you're going to have other costs attendant with disposing of a property. Losses then, capital losses, can be used to offset gains, and unused losses can be carried forward to later years. So if you sell shares or sell a house or something in 2017 or 18 and you have a capital loss, you can actually carry that forward for later years to offset against a gain. There's a multiplier situation. Capital gains tax was introduced in 1975, and there is a table containing a multiplier. This was introduced to take into account the effect of inflation on assets and had the effect of increasing the base cost of the asset. So an asset, for example, that you may have acquired in, let's just say, 1965, the cost of that will depend, the cost that you're going to use from the point of view of capital gains tax calculation. You'll be applying a multiplier to that because it was bought prior to 1975. After the 1st of January 2003, indexation was done away with. So after the 1st of January 2003, indexation is not allowed for acquired assets, therefore there's no multiplier. However, if you bought a property, for example, in 1999 or 2000, there will be a multiplier. So you might have bought it for 200 grand, you might have a multiplier of 1.6 or something to account for inflation. You're allowed to use that multiplier then to drive up the cost, because the purpose is to take into account the effect of inflation. In other words, you might have bought a house or a property, for example, for 200 grand in, let's say, 1995. The cost of that now is going to be greater, but it's not all attributable to capital gain, because a lot of it obviously is attributable, a lot of the price rise is attributable to inflation. So the multiplier is to take into account that effect of inflation on the value of your asset and on the value of your sales proceeds. There's an annual exemption, and in 2020 it's for individuals, it's €1,270. The computation then, you can see on the screen there, a very basic sort of a computation. So it's the proceeds of sale. So you sell the asset for 250 grand, say, let's get rid of that. Then you take away the cost of the asset, the cost of acquisition of the asset, for example, legal fees, stamp duty, any enhancement expenditure, and that'll give you a chargeable gain. Off that chargeable gain, then you take any allowable losses. So you may have allowable losses coming forward from a previous year, and you take off your annual exemption of €1,270. That will arrive at then a figure of whatever it is for taxable gain, and you apply the capital gains tax rate, which currently today at 2020 is, I think, 33%. Voluntary disposals, again, a voluntary disposal, that is a gift, is a disposal and may give rise to a capital gains tax liability. The cost of the asset then will be the market value at the time of transfer. So let's say you or somebody makes a disposal of a site to a young person to build a house. Then the value of the site is, let's, for the sake of argument, say 20 grand or 50 grand or whatever. Then that's the market value. It's a gift, there's no money changing hands. But the value from the point of view of a capital gains tax disposal calculation will be the market value. So you would want to get a valuation of the site at the time. So as I say, it could be 20 grand, 50 grand, obviously depending on where the site is located and so on. And whether it has planning permission or not. Part disposals then, as I say, if you transfer a site out of a bigger lump of land, a bigger folio, then obviously it's not a disposal of the entire folio. It is a part disposal, however, and capital gains tax will apply. Development land, there's special rules in relation to development land. A company must pay capital gains tax on such disposals, not corporation tax, and a company will normally pay corporation tax on an ordinary disposal, which might give rise to a capital gain. So if a company, for example, sells a premises, a business premises, and has a capital gain, for example, to sell a shop or an office or a warehouse, then they can treat that, deal with it by way of corporation tax, not capital gain. However, if it is a sale of development land, then a capital gain must be paid on such disposal. There are a number of reliefs then. Again, as I said at the outset, I would caution you to get legal or taxation advice from either an accountant or a tax consultant. Some accountants are very good at bookkeeping and submitting accounts and so on and so forth, whereas sometimes you will have a need for an actual tax consultant, a specialist tax consultant. If that's the situation, well then, if I was you, I would advise you to spend a bit of extra money and get good tax advice. The reliefs, as I mentioned earlier on, there's the principal private residence relief. There's also a dependent relatives and principal private residence relief. That is where you might have a house, you don't live in it, but a dependent relative lives in it. In those circumstances, then will be relief if certain criteria and certain conditions are met. Transfer of a site to a child, again there's a relief here. The value of the site can't exceed $500,000 and the size of the site can't exceed 1 acre. If that's the case, then there is no or there is a relief for transfer of a site to a child. But again, just look at the conditions. There's a credit situation then for capital gains tax against CAT, capital acquisition tax. In other words, there is an offset there of one tax against the other in a particular transaction. An inter vivos disposal between spouses, that is a living disposal between spouses, both spouses are still alive, then there is a relief there. There's no capital gains tax liability going to arise. Assets passing on death are an occasion when capital gains tax will not arise. Settled property, there is a relief in relation to settled property, and then there is other reliefs, disposal of a business or a farm. There's a retirement relief that you may be able to avail of, and there is the disposal of an unincorporated business to a company that may give rise, provided certain conditions are met, to relief. Final word, as I say at the outset, and I've repeated it a few times, I'll repeat it again, and I make no apology for that. Get tax advice if you are dealing with capital taxes, such as capital gains tax or capital acquisitions tax, because any mistake in respect of either of those taxes can be fairly eye-watering and stomach-churning. My name is Terry Gorry. My contact details are on the screen there. Hope you find this video useful. If you do, I would appreciate if you gave it the thumbs up down below, and you may be interested in subscribing to my YouTube channel. On my channel I deal with Irish business and Irish law, and I produce 2 videos at least every week. Thanks for watching.